you don't want to catch a falling knife, and everybody's going to get out at the same time. And in a very crowded trade, you're going to have everybody going for that same exit door, and you're going to have these type of moves. The other thing is that what people aren't used to is the price. And, gold being over 5,000, and where were we, 2,600 a year ago. I think the higher the price goes, the higher, the wider the ranges are going to go. And people have to get, unfortunately, used to the wider ranges. In addition to that, I think certain things could have caused this sell-off. Obviously, Chinese New Year is in front of everybody's mind. Traditionally, we see a little liquidation beforehand, and then after Chinese New Year, we'll work our way back up. The other thing that I think that's important is that the VAR is significantly higher for banks.
Yeah, right.
What that means is the size of a position that a bank was able to warehouse at 2,600 may have halved based on the price of gold almost doubling. So, for instance, a 100-lot silver EP, which would be 500,000 ounces of silver, is creating maybe $300,000 of VAR. So basically, you're not getting banks able to warehouse risk, which then creates even more exaggerated moves.
And I mean, Bob, let me take it one step further, because margins are one thing, but the volatility itself changes the math inside every institutional risk model. And you're bringing up VAR, that value at risk, and it does become critical at these levels. When silver moves 10% in a session, what does that do to allowable position size across banks and funds? Are traders choosing to sell, or are they being forced to reduce exposure because their models demand it?
Well, it's a great question. And my point on that is that each bank is given a certain VAR for that business. Now, when the price of gold goes from 2,600 a year ago to over 5,000, it's almost double. And silver, it's even worse. It went from $28 to $72, 152% up in a year. And then don't forget, we're still up for the year in 2026. So the allowable positions based on the VAR become significantly small. And then when you take into account volatility, so before the last crash, silver had over 100% implied volatility. Yeah, if I was a trader, I'm not going to want to be holding any positions, because you're going to be way too exposed to potential losses. Mm-hmm. So therefore, banks are taking less risk because of the volatility, because you don't know where it's going to end up. And they're also not allowed to take the same positions, because the VAR limit is a dollar limit, and because the price has doubled, your basically positions have halved.
Right. And hey, do algos amplify VAR stress? If volatility spikes, do those same systematic kind of funds mechanically cut exposure?
Well, I'm not sure about cutting exposure, but they certainly increase volatility and create these flash crashes. For instance, the market isn't significantly positioned today. Managed money on the CFTC is only long 5,000 contracts. So on a day like this, where they're not actually having any major position, the algos may be calling to go short. And that may be help spiraling that sell-off. The other thing is that everybody has to get used to much wider ranges with a much higher price. Right. If gold was 3,000, maybe you're expecting a $20 range, but when gold is 5,000 and we're still looking for support and footing of where the price should go, then that's going to exaggerate the moves as well.
Yeah. Hey, let's look at the CO2. Or the commitment of traders report. It's kind of a reality check, because the last positioning data showed managed money wasn't excessively long. So if this wasn't hedge funds dumping a credit trade, who was structurally vulnerable? Is it possible this wasn't about direction at all, but about capital efficiency? For example, funds simply reducing gross exposure ahead of this holiday window in China.
Yeah, I think that ahead of Chinese New Year, everybody's afraid of that sell-off. And you don't want to be the last one in. So if you see selling and you're a CTA or a hedge fund, you don't want to explain why you didn't get out. So I think that selling begets selling in a market like this when it's nervous, and also implied volatility. If silver's implied volatility is around 100%, it's going to exaggerate the moves as well.
It's interesting in terms of the philosophy of a Japanese technical analysis in what they focus on. When I say that silver closed down $10 or $50, we know intrinsically what I've said is I've compared the close of yesterday to the close of today.
Yeah.
The importance that Western traders place on a close-to-close relationship is tantamount to one of the most important things. That's what they announce on the news. The Dow is up or down, and they're referring to close. To a Eastern technical trader, the most important information they can derive is, did the market close above or below the opening price? Because they view the market session really as a battle, and red tells you that the bearish faction was able to overwhelm the bullish faction, and the reverse with the green. So when you get these long green candles, or long red candles, it means that there's tremendous selling pressure. Below that is what we call the wicks. And the wicks are the difference between the real body, the open and close, and the low and the high. Very small wick on this one brutal day. Kind of a long wick on the lower one, but the body size is so much larger than the wick where we have to focus on body size. So when I look at silver, I can see that towards the end of December, silver consolidated right around 70. You see these series of bottoms, whether they're green or red, and then it ran aggressively to the all-time record high. When it came down, these wicks have touched near this point, and the fact that it's below the 50-day moving average tells me that we could be seeing a pivot. I'm not convinced yet. I need to see multiple days and further declines. But I draw your attention to this one area, because the area of about $70, based on what happened at the end of December and beginning of January of this year, tells me that's where we want to look for potential support in the market. You can also see these wicks came very close. So this is the line in the sand in terms of whether or not what we're witnessing is a deep, but brutal sell-off that is really been instigated, implemented by traders taking money off the table, profit taking. Profit taking is different, obviously, than a fundamental shift. We haven't seen the fundamental shift. We have seen a technical sell-off.
Yeah, good point. And, I got to ask you this, because I always get questioned as well. We've seen a pattern where silver trades higher during the Asian session, then gets hit when the U.S. market opens. From a technical and future market standpoint, what does that tell you? Because we know a lot of this selling was mechanical, leveraged ETFs and kind of futures margin calls.
It could be a number of variables. Typically, the Asian markets have been very aggressive in bidding both gold and silver higher. And then we've got really, in the old days, I say that with some humor to it, because it wasn't that long ago.
Yeah.
There were market sessions. We opened at 9:30, say, and we closed at 3:30 in gold. And then the night we came on, and then you had the next morning session. So if anything happened during that nighttime void, when things can happen, but at the same time, there is no futures market where you can implement a trade, is much different than the 24-hour markets that gold and silver have gone to. In other words, I'm going to give you Hawaiian time. You just have to add 5 or 6 hours to get Eastern. But opens on Monday. On Monday at a certain period of time, around 1 in the afternoon, it's closed in New York. It goes to Australia, Hong Kong, then London, and it circles all the way until Friday. On Friday, New York closes of the week. It stays closed until Monday morning in Australia, the first market to open, which is Sunday here around 1 o'clock. So there's all these opportunities. We never have a void in which you can't place a trade. And so what that tells me is that it's not a series of stops that just got hit because the market opened. And a stop definition is that if you put a price stop, good, kill, cancel, stop, when it hits that price, it's executed at the best available price, which means that if a market closes at 75 and on a Friday and then opens at 65 on a Monday, your $70 stop didn't get you out at 70. It was never there. It's executed at 65. So because we have 24-hour markets, we have a smoother transition. We have less gaps in the data, meaning price voids. Technicians look for that to get filled. This has just been solid and strong selling pressure. Absolutely.
Yeah. We've seen two sides of the same coin. A brutal technical liquidation that shook the weak hands out of the market, and a resilient structural support level that hints at a potential floor. While the paper price has been hammered by algorithms and dollar strength, the physical reality of supply deficits hasn't changed. Is this $70 to $75 range the ultimate buy the dip opportunity of 2026, or is the silver bull market officially broken? We want to hear from you. Are you holding steady through this volatility, or has this recent crash changed your outlook on precious metals? Let us know your thoughts in the comments below.